right, good morning and good afternoon. Thank you for joining our Turning Tides webinar today, where we will discuss the viability of investments in LNG using Canada's British Columbia as a case study. So my name is Hannah, and I am a part of the events and communications team here at Carbon Tracker. The intended runtime of this webinar is 50 minutes, depending on the number of questions asked, with a 60-minute hard stop. There will first be a short presentation of the key points before we move to answering your questions. If you'd like to ask a question, please do so using the Q&A function. Please do not send the question anonymously. If we're unable to answer it live or if it requires a follow-up, the team will be in touch afterwards, and a replay will be sent after the webinar, as will the link to download the slides. So Carbon Tracker is a not-for-profit financial think tank. Our vision is a fully decarbonized global economy well before 2050. All of our research converts climate science into financial risk and reward, with the aim to accelerate the energy transition by mobilizing the financial markets. Our work, including this report, is free to access or download from our website. So joining us today for this session is Maeve O'Connor, who's the analyst and lead author of this report. Maeve joined Carbon Tracker's oil, gas, and mining team in 2022 and has since authored reports including Mispitch, Absolute Impact 2022, and Paris Malign 2. Joining Maeve is Rich Collett-White, who joined Carbon Tracker in 2023 as an analyst on the oil, gas, and mining team, and prior to this worked as an editor and reporter at DSMOG, investigating misinformation, greenwashing, and the influence of vested interests on climate and energy policy. So Maeve, over to you.
Good morning, everyone, or good afternoon, and thanks for joining. So, as Hannah kind of alluded to in the introduction, our purpose here at Carbon Tracker is really to help investors to navigate the energy landscape and really to ensure that their investments are future-proofed against the quite seismic changes that are occurring in the global energy sector. So really, our core investment thesis is that the rapid, non-linear adoption of electric and renewable energy technologies presents serious risks to stakeholders in the legacy energy system, and that's both investors and corporates. And those risks will really be amplified to those who fail to recognize the direction of travel and who fail to adapt to survive. So one issue that has really come to the fore of the energy sector over the past few years is liquefied natural gas, or LNG. And there has been a certain kind of exuberance from the oil and gas industry about LNG, particularly since 2022. We've seen a lot of narratives that LNG is a transition fuel that will act as a bridge between the old and the new energy systems. And today I'll outline some of the research that we've carried out in the LNG sector, which kind of makes a case for why LNG, is indeed a component of the legacy energy system and is therefore exposed to transition risk, just as oil and gas are. Our hope then is that you would consider some of the factors that we outlined today in your own investment decision-making processes, and particularly during engagements with oil and gas companies on the subject of LNG. So if I'm to first turn to some trends in the LNG markets as of late. So there has been quite a lot of news that I'm sure a lot of you are aware of about the raft of new LNG supply that is set to come to market beginning from this year and out into the next few years. The LNG market, like that of oil, is cyclical, and when gas prices spiked in the wake of Russia's invasion of Ukraine, many new projects were sanctioned enticed to market and sanctioned, and those projects are beginning to come online now. So volumes are set to increase such that global LNG capacity is set to increase by about 50% by 2030. And many market analysts are forecasting a glut of new LNG supply by the end of this decade. So concurrently, forecasts of future demand for LNG have been quite uncertain and in some cases are falling. The figure on the left is from the IEA and demonstrates kind of the stark downward revisions that we've seen in the IEA's central natural gas, and not quite LNG, but natural gas demand forecasts over the last few years. And indeed, LNG hasn't been immune to these trends either. Shell, which I think is an interesting example, as it's a company which has really put LNG to the forefront of its strategy as of late, revised its forecast for LNG demand in 2040 down by up to 14%, depending on the scenario, just between 2023 and 2024. So I think the message that I'd really stress here for investors is to consider that, okay, well, if I'm to make an investment in LNG, or if I'm to generate exposure to LNG, what demand assumptions am I basing my investment on? And what's the implication for my investment if those demand assumptions drop 10% year over year? So given those kind of that market backdrop, if I'm to turn to some of the results of our analysis of the LNG markets. So we've modelled global LNG supply and demand in our report Turning Tides. And we find that yes, supply from already sanctioned or post-FID final investment decision projects is indeed sufficient to fulfill LNG demand under all of the IEA's demand scenarios. You can see here in this chart that supply is represented by the shaded grey area, and is indeed more than sufficient to meet demand under a fast transition NZE scenario or 1.5. And indeed also more than sufficient to meet demand under APS or a moderate transition scenario. And indeed steps now that I looked at it again. And we also include, in our analysis, Shell's own Archipelagos energy security scenario, which we included to offer kind of a more bullish view on LNG demand. So in a market that is adequately supplied by existing projects, how will new projects compete? And at Carbon Tracker over the past few years, we've developed and based a lot of our thinking on what we have called our least cost methodology for oil and gas assets. And in Turning Tides, we applied that kind of methodology and thinking to LNG and built a cost curve of global LNG projects. So the idea here is thinking that we're kind of really relies on the thinking that it is the lowest cost supply that will be used to meet demand. And here you can see on the horizontal axis that we have cumulative demand and supply for LNG out to 2040, and the adjusted break-even gas price on the horizontal axis, or excuse me, on the vertical axis. And each of the bars in the chart represent a different LNG project that is yet to be sanctioned, and they are coloured by region. So just to reiterate, demand is fulfilled under each IEA demand scenario by existing projects. So as a result, the demand lines for these scenarios in this chart are all at zero because there's simply no need for new projects. Shell's Archipelagos scenario, there is space for new LNG projects, and we derive a marginal break-even price based off that quantity that's needed, which is about at the $10 mark, which is kind of just above a rough kind of cluster of broadly or of similarly priced projects in the middle of the curve. So that's our kind of view or our cost curve of global LNG projects. And we have looked at two different case studies of kind of groups of LNG projects. The first we published in Turning Tides just before Christmas, which focused on British Columbia. And for background, British Columbia has kind of a nascent LNG industry. It has vast gas reserves in the Montney Formation to the west of British Columbia. And there has been talk of developing an LNG industry there for about the last 2 decades. Its first project, LNG Canada, is due to start producing shortly, and several other projects are in the pipeline. So we looked at those pipeline projects in British Columbia and placed them on our LNG cost curve. So you can see, that they lie relatively far up the curve. Excuse me, I've just lost my slides. Yeah, you can see that they lie relatively far up the curve. And I think most notable here is LNG Canada Phase 2, which Shell is a lead partner. And even that project falls well outside or it's sufficiently high cost such that it falls well outside of our modelling of Shell's own Archipelagos scenario. What you might ask are the drivers of BC's relative uncompetitive position? Well, in the report, we looked at some of the cost drivers of project in British Columbia. And we found that their unit cost of production is about 60% higher than the global average and is significantly more expensive than key low-cost competitors like Qatar. This is largely down to British Columbia's higher SG&A, or selling, general and administrative costs, which include things like staff costs, professional costs, and insurance. And I think, moreover, to kind of add substance to the claim that BC will be at a disadvantage is really that it's going to be a late entrant to a market that's dominated by established operators like Qatar and indeed like the US, which have kind of long established industries and plenty of, particularly in Qatar's case, greater opportunities for scale. And I think these kind of comparative disadvantages have been somewhat recognized by the industry when it comes to BC, because through the 2010s, over 20 projects were proposed in the region, but most have been shelved. This second case study that we looked at comes from a report that has yet to be published, but soon will be, which looks at several other LNG projects kind of more globally. And these include several projects in the global south that have some of the majors as significant partners. So we have two of the projects in Mozambique, Remuva Phase 1 and Coral North, which are both equal parts partnered by Exxon and Eni. And then also Papuan LNG in Papua New Guinea, where Exxon and Total both have quite a high stake. And if we are to chart these projects on the global cost curve, I think the real takeaway for investors from this is that projects in the global south are not necessarily going to be cost competitive. You can see that Coral North in Mozambique there is kind of nestled among a cluster of North American projects, and Papua LNG lies kind of even further up the cost curve again. And I think as well, with especially considering projects in a place like Mozambique, there's needs to be due consideration of additional risk which are involved with operating in such countries. Most of the LNG projects in Mozambique, for example, have been under force majeure for several years due to the geopolitical conflict there. And so I'll stop with the presentation there and just leave you with a few key takeaways. First being that future demand is uncertain and could indeed be trending downwards. And that is kind of a key consideration that investors should incorporate into their financial modeling and investment decision making. The second then is that all LNG projects are at risk under the IEA scenarios, as supply is sufficiently met by existing projects, which means that investors are at risk of generating lower than anticipated or lower than hurdle rate returns from new projects. And lastly, I'd say that new LNG projects will likely compete on price. And so it's imperative to consider a project's kind of relative price competitiveness when ascertaining its viability as an investment. So I'll leave it there and turn it back over to Simon.
Great. Thanks, Maeve. Hope everybody can hear me, and happy belated New Year to all of you. And I hope you had a very good holiday period. We're back for our 2025 webinar series. I think starting it with a cracking subject. This is a big topic, and let's delve straight into the questions. And we've already got quite a number of questions coming up. On there, we're always looking for more, and if we don't get round to answering your questions live, we will certainly look to follow them up afterwards, either in an email exchange or a further follow-up call. So thank you very much. Maeve, before you sort of sit down, and I know we agreed that Rich would crack on first, but there are a couple of sort of minor technical questions coming through, which I'd like to, which were concerning the charts. Firstly, do you have these cost curve charts broken down by company?
And we do have the backup data on that. It's not something that we've published yet. but we've kind of decided to go for regions due to, I guess the first project being focused on British Columbia, hence the charts being broken down by region. But if the audience member would like to get in touch for any kind of further details that could be broken down by company, please do.
Okay, thank you. The second sort of technical question, if you like, is what was the rationale for choosing those projects that you added outside of British Columbia? Was it just their size, their importance, their high profileness? What exactly did you say? Okay, we want to include these in the projects, these new up and coming projects in the into the chart.
Yeah, of course. And that's a great question. And I guess I kind of deliberately left it out in order for brevity's sake for the presentation. But actually that project, which is likely to be published in February, looks at financing by export finance agencies. So those projects that I had listed are ones that, at least at the time of the analysis towards in Q3 last year, were up for financing by export credit agencies, so Exim in the United States, and also JBIC and some others around the world. So hence that was kind of the universe for that particular project.
And I'm sorry, Maeve, to carry on because the questions are coming in, particularly around this cost curve, and we might as well cluster them together. What about Nigeria? Have you done any work on those projects coming online?
No, I have to say we haven't looked particularly at Nigeria. I guess to say that, yeah, frankly, I wouldn't be able to offer too much of a view on Nigeria at the minute.
But is it something that is relatively straightforward to be able to do for Nigeria, to add Nigeria?
Oh, of course. Well, sorry, I should say Nigeria's unsanctioned LNG projects are in that cost curve. The curve covers, all projects globally, so there's no country excluded. I guess what I mean to say is that I haven't looked at the projects themselves in detail, so I wouldn't be able to provide any kind of anything further than that at the minute.
Okay, and the last one before you can put your microphone down and we'll go and pick on Rich for a bit. It looks like some of the, Mark asks, it looks like some of the new projects will be more competitive than existing. Can you perhaps point investors to the ones that they should be going, oh, that looks quite a good one?
I think, well, I think based on the results of the cost curve, so those to the left closer to the origin, and a lot of those are in the Middle East and a couple of mega projects by Qatar. And I think that stems or can be boiled down to the fact that kind of for the Qatar gas, they're kind of 17, 18 train LNG facilities that they have. So to add an additional couple of megatons of capacity is a lesser ask than, for example, to build a full new LNG facility elsewhere.
Okay, let's, Maeve, grab yourself a drink of water and let's bring in Rich on this. Rich, policy action is always the wild card for investors, and there's quite a lot of policy action going on at the moment surrounding the European Union with regard to particularly methane emissions. And there is a tussle between the industry saying, well, we can't introduce those, the rules are too grey, between and the regulator saying, well, the principles are there. There's enough there for the industry to go on, stop whinging. I think the key thing for people is, okay, and this brings in a question right at the beginning by our good friend Pierre, that's talking about energy tribalism, if you like. We've got parts of the world not wanting to buy off other parts of the world, and parts of the world quite happy to buy off those parts of the world. So, the energy market is almost becoming buy off your friend. And the EU is bringing in, saying people have got to, buyers or suppliers of LNG to Europe have got to prove that it's low in methane, etc. I mean, is the EU on a hiding to nothing, and this is just going to be all about price, or is there teeth in there, and that the EU can be a price setter, if you like, for a sort of green premium, if there is indeed a green premium? Maybe there's not. Maybe Qatar is low cost and low methane. What are the key points investors should be looking at when considering this energy tribalism and what the EU is trying to do in the LNG space?
Thanks, Simon. Yeah, it's a great question. A very timely topic. And yeah, as you say, there's a huge amount of attention and kind of concern around methane emissions at the moment, and that's really driving policymaker action on this. And as you say, the EU methane regulation is really the kind of the key one here when it comes to imports, because the standards that it's bringing in will impact imports. And I think the key market there is US LNG, because it has significant methane emissions through the supply chain, and that's clearly something that investors need to kind of take into account. They need to have transparency from operators on what the methane emissions are kind of through the supply chain. We know that technology is developing rapidly in this area with satellites and drones and aerial flyovers kind of revealing previously sort of unknown emissions. And so that's clearly something that investors need to be pressing project developers on. Will they be able to potentially enjoy a price premium on kind of low methane LNG, or will they actually fall foul of some of these regulations and not be able to access certain markets? Are we going to see similar efforts going on beyond the EU on this issue? There are certain buyer coalitions which are now kind of picking up pace on demanding low methane sources. That's the case with one in Japan and Korea called the Clean Coalition. So yeah, it's really something that investors need to be taking account of. It's another source of kind of risk for them in this area, in addition to the points that Maeve made through her presentation.
And on that, Maeve, firstly, do you think you can take the final slide down, the key takeaways, then we can see your smiley faces a bit better?
Thanks.
And my new haircut, I hasten to add. On that point, Maeve, how have you, in your cost curves, if you like, have you got a guide for investors on the methane exposure? So, they can say, well, okay, this looks relatively good to me, but there is a potential policy risk that could come out of the bag and scupper my earnings model or my valuation model of this particular company.
Yeah, I think when you're to kind of turn to kind of exposure for methane risks, the first place would look to kind of on a company level, and our absolute impact, most recent edition of Absolute Impact before Christmas, evaluated the emissions, but also the methane targets of some of the kind of largest oil and gas companies, including those that are covered here, and identifies shortcomings in where they exist in those targets. Particularly relevant to this and on a project level, I think, is to look at companies' non-operated projects. So those in which they're just a joint venture in, because I think, and Rich could speak more in more details to this, but that's really where we've seen companies kind of shy away from taking responsibility for methane emissions is those projects that they don't fully operate.
And okay, let's bring in the T word. word, shall we? The Trump word. And the first question that I think we want to ask is look, the work on the British Columbia models that you've done, how easy is it to sort of use that for other countries such as the US? The US has drill baby drill. There's large numbers coming out into terms of the amount of exports they're going to be promising into the marketplace. How easy is it for investors to take your BC model and say, well, okay, let's run that through for the US?
Yeah, of course. Well, there's plenty of US projects in amongst the cost curve that are fairly evident as they're kind of North American, excluding Canada. And I think around kind of Trump and what you can expect in the change in LNG markets, I wouldn't, in terms of like project sanctions, there still have been project sanctions like CP2 in Louisiana over the last year. So I don't anticipate it's that kind of Trump's reversal of Biden's export pause will have like a major impact on the market, simply because it hasn't been there long enough to really have delayed or cancelled or have resulted in the cancellation of many projects. And I think simply those that were in train will probably just be pushed down the line a little bit.
Okay, and Rich, can I ask you, one of the key arguments used by corporates to justify their increase in LNG supply is the coal to gas argument. Now, we know coal to gas argument is a bit spurious, for example, on the emissions level. We don't want to go into that here. What I'd like to go into and say, you know, the IEA in their WEO report said that much of the LNG export supply that's coming on the market need prices well in excess of what the global south, particularly the global south, is willing to pay. And that a recent study by RMI using IEA data, etc., is saying that 87% of the global south's generation capex is already directed to clean energy. What's going on there? There's clearly a mismatch between sort of hopes and dreams.
Yeah, I mean, I think that assumption that LNG would displace coal is fairly shaky. I mean, when you look at what kind of electricity generation it's going to potentially displace, there's really no guarantee that it's going to be coal that gets kind of pushed off the system. If you look at the US Department of Energy has just come out with a study looking at what impact the increased kind of US LNG exports would have, and they estimate that actually a lot more renewables would be displaced from increased exports. So I think that justification needs to kind of come with a bit more evidence when corporates are kind of making those claims.
Okay, Maeve, in your one of your slides, you showed the IEA's sort of LNG forecasts that have gradually ticked down. What you didn't show was in 2024 it ticked up a bit. And I'm sure all the people on this call know that. What does that mean? Why did it tick up a bit? Is it a secular reversal, or is it just a blip?
Yeah, thanks, Simon. And just to clarify, that chart is of natural gas kind of writ large forecast, not just LNG. But you're right, it did tick up in 2024, basically back up to the level of 2022. And the reason behind it was because contractions in demand in advanced economies like Europe were offset by stronger than anticipated gas demand in China, as well as additional demand in the Middle East. So I think, yeah, the message really to comfort is that the demand has kind of continued to be falling in advanced economies. And really that kind of China is the unknown in demand forecasting. But I guess you kind of caution investors against betting on China to bolster future demand, not least or future demand for kind of Western LNG, not least because the government there has been very adamant on its intention to boost domestic production of gas, which it has done over the last couple of years, as well as a kind of a massive rollout of renewables. And both of those are being done with the aim of shoring up energy security in the country. And then secondarily, what imports of gas and LNG that China do buy are largely bought from places like Russia, Turkmenistan, Qatar, and to an extent Australia as well. So I guess what I'd say is that kind of increase, to look beyond, kind of dig into the weeds of a forecasted increase in demand and kind of ascertain to what extent that could really mean for demand for listed Western companies' output.
Okay, and to follow up, an obvious question really from Nick here saying, what do you think the likelihood of oversupply leading to lower prices will do on stimulating more demand? I mean, how material is this? And what prices would be needed to stimulate, significant demand? And at what point, I mean, I guess, how do investors say, well, okay, how do I know which companies are going to lose money? I mean, I presume they go onto the cost curve and you do it company by company. But what is the danger that this oversupply will create demand and a scrabble for cash flow to at least get something back on all of this money they've wasted?
Yeah, of course. And it's a really good point. And I mean, the transition isn't going to be linear, or it's not going to be, there's going to be kind of volatility in demand year on year, and low gas prices could certainly spur a bit of an uptick from importers year on year. But I think there's lessons kind of to be learned from, or importers certainly took lessons from the volatility in 2022 and 2023, and particularly in kind of more developing countries, you've seen a big shift away from LNG in their national energy policies. Like Pakistan, for example, have stopped the construction of new LNG-fired power plants. And Thailand have also kind of been vocal in shifting away from it. So I think it's parsing when it comes from, kind of thinking about what price would have on demand, is kind of parsing the long-term structural trends from kind of year-on-year volatility.
Okay, and a question here from Assad. Thanks, Assad, for joining us. And it's saying, do you have an opinion on the upcoming shareholder resolution filed by the Brunel Pension Partnership, along with other members of the LGPS and the ACCR, asking the company to share how its LNG growth strategy will meet its climate targets?
Yeah, thanks, Simon, and thanks, Assad. I think that's a really interesting resolution that has been put forward. I was reading it the other day, and really actually what it comes down to is the investors are asking Shell to provide more clarity on the basis on which it has designed its LNG strategy, which even and kind of even going down to what it how it has created its LNG demand forecasts. It points out, as one of the slides kind of indicated, how much higher Shell's view of future LNG demand is of the IEAs, and that's something that the shareholders kind of point out in the resolution. And I think it speaks to, the fact that alternative or that shareholders are really taking into account kind of alternative views of the LNG markets and comparing them to that of companies. And if projections look a little bit too rosy in their eyes, that's when you're going to start to see pushback from investors.
Yeah, I mean, looking at Shell, they've consistently cut their sort of LNG targets, if you like. as your report said, and looking at the recent quarterly numbers, they even failed to miss those. Now, you could say, an investor could say, they do take into account quarterly numbers, but obviously just with one eye closed, etc. Is a lot of these resolutions may be seen as a climate issue. Here we go again. Should this resolution be seen by Shell investors not as a climate issue, but actually as you're wasting the company's money, that means you're wasting our money? Is it beyond the climate issue this time?
Yeah, absolutely. I think so. I mean, these LNG projects, particularly those that Shell are involved in, are massive, like really capital intensive and long lifespan assets. I mean, LNG Canada, its project in British Columbia was the biggest, I think, singular infrastructure project ever in Canadian history, or one of the biggest at least. So, like the quantums involved in these projects are massive, and they have extremely long payback periods. And putting aside the climate concerns, which are certainly relevant and are many from LNG, but simply as an investment decision, as an investor, you should, if the alternative is between, having excess cash returned to you in the form of dividends or buybacks, or being invested in a massive long-term, very risky asset that may not have, may not acquire the kind of or may not find the customers it needs to buy the output, or indeed whose output might be sold at a much lower price than anticipated at the point of investment. I guess that's when shareholders really need to be asking, is that the best use of your capital?
Okay. We've got a couple of questions on AI. It seems to pop up all the time, hyperscalers, etc., etc. Do either of you have a view on how this will affect energy demand and therefore the LNG demand? If you don't worry about it.
I mean, yeah, it's not something I looked at specifically and related to LNG. There's obviously the consideration that the strain that AI and data centers and their requisite computing power will place on national energy grids. I think ultimately that's probably down to it's a governmental decision to decide how to deal with the excess strain placed on grids and how best to power it. But as kind of our research has demonstrated time and again, that renewables provide kind of a safer, cheaper and more secure source for that energy. Rich, I'm not sure if you've got anything to add there.
Yeah, just to add, I mean, it obviously is a kind of key trend at the moment. Lots of interest in this. I do think it's potentially sometimes exaggerated just how much of an increase it would lead to, and I think then it's another step to say, would that be met by gas or by renewables or even by nuclear? Lots of there's lots of kind of talk at the moment about tech companies potentially looking at nuclear, at small modular reactors. But then at the same time, lots of technical companies have very strong climate mandates on kind of using renewable energy to meet that kind of data center demand. So yeah, and I believe that's incorporated into the IEA scenarios. But obviously it's a fast changing kind of backdrop, if you like.
Yeah, I think Amazon have just done the largest truck order in the UK for electric vehicles. It would be rather curious that these tech companies would suddenly, and they in a lot of the cases they have been doing the driving of cleaning up. They well recognise the responsibility they have. So it would be a rather odd decision for them to go, oh yeah, we'll do LNG instead, stuff it. Especially when they're talking about paying through the nose for nuclear. Yeah, I think when you look at when you look at it's growing very fast, but it's still quite a small amount. And there's an awful lot of other things that can be that can fall away before the demand for in this particular area becomes material enough to start replacing the fall off in other demand in other areas. Look, I don't want to look. We're coming up to 45 minutes. I think. For me, the last question I'd like to put to you both is, look, what are the risks to investors if an LNG facility fails to secure long-term offtake agreements with customers? And mixing in that is that we got Venture Global, one of the biggest US LNG developers. They're planning an IPO very soon. It's going to value the company at 110 billion US dollars, which is very close to ConocoPhillips. Securing long-term contracts, is that an absolute must for an investor looking to invest in either, when they're assessing a project and whether they want to, either a bank wants to finance that project, or can they rely on the spot market or shorter term contracts?
Yeah, so I think historically, having a large amount of output contracted would have been a condition for a bank to finance an LNG project or provide project financing. The kind of financing, the financing structure and just the industry landscape has changed such that the proportion of output that is contracted has been falling significantly. I think the IEA has a figure of about 30% of the output that is currently under construction is not contracted for sale. And that obviously leads, the contracts are of course kind of a hedge for operators and their investors for revenues. If offtake contracts aren't achieved, they will be reliant on the spot market, which we've seen can be extremely volatile and may end up delivering revenues that mean that investors generate kind of lower returns than were expected at the point of investment. And the other thing I'd say on this that we haven't really touched on today, but that does form a core part of Carbon Tracker's research is decommissioning. And so an LNG export facility is kind of saying a massive, quite long-term or a long lifespan asset. And if it needs to be decommissioned earlier, those decommissioning costs will be brought forward in time and therefore kind of increase on a present value basis. And so the asset could flip to become a balance sheet liability, kind of unbeknownst or to catching kind of investors and corporates off guard. So yeah, I guess those are two things would be the risk of relying on spot markets for revenues and also the risk of decommissioning being brought forward in time.
Yeah, thanks, Maeve. We ought to mention that report. Can you remember what it's called? Because I was just trying to look it up, and I've closed everything down. It's anyway. We'll perhaps try and look that up in a moment, Maeve. Maybe while I just do a couple of other things here. Really, thank you very much for joining us. We hope you found that approach to LNG useful, much more from an economic, financial materiality point of view. Next time you'll see us is on the 29th, where we're going to do the same again, looking at the economics behind the much advertised pivot to petchem. Will petchem save the oil and gas industry from the decline in the demand for transport fuel? So please join us on the 29th for that. The report that that Maeve has just mentioned, if you go to our website, www.carbontracker.org, and type in off the record, that delves into the early retirement obligations, which in some cases can, in some companies can, particularly looking at the top I think it's the top 6 US refining companies, it shows these liabilities which are almost certainly off the balance sheet, can be as much as 50% of shareholder equity. So they are material, and we would urge people to look at that report to see how things like a slump in LNG demand could also wreck the balance sheet as well as the P&L. It remains from me to thank Hannah, who works tirelessly behind the scenes to make us look vaguely professional. To thank Maeve and Rich for the presentation and answering the questions, and most of all to you, the audience. Without you and without your feedback and without your questions, one, it wouldn't be half as fun, and two, it wouldn't be half as informative as well. And so it remains for me to say goodbye. The slides and a recording will be available to you after this, and we hope to see you on the 29th for Petrochem Imbalance. Goodbye.